Parkway Life REIT just celebrated a 15.1% spike in their distribution. But behind that headline, their underlying organic revenue actually contracted by 2.1%. If you are relying on this asset to fund your CPF retirement payouts, you are currently buying into a yield that mathematically fails our absolute minimum safety hurdle. We are going to audit exactly what the management presentation masked behind cross-currency swaps and engineered distribution bumps. I have been tracking this specific counter for a while, and the situation in Japan is what finally made me sit up and run the data twice. When a supposedly stable sanctuary asset sees its core geography start to erode, we have to look past the summary slides and dig into the actual cash flow. Let us look at what management led with in their latest update. The headline that management wants you to focus on is the 15.1% jump in distribution per unit. They are pointing to an uninterrupted growth streak and a strong balance sheet to justify the narrative. But the very truth is that gross revenue dropped to 38.2 million Singapore dollars. When we audit REITs, we lead strictly with distribution and gearing. The headline numbers look fantastic on the surface, but a forensic investor needs to know exactly where that cash is coming from. If the organic revenue is shrinking, that distribution spike is being generated elsewhere. That brings us to the mechanics driving the payout. The 15.1% growth is not coming from broad portfolio strength. It is driven entirely by a singular mechanical lease event right here in Singapore. The 3-year rent rebate program for the Singapore hospitals has officially ended, and the new annual rent review formula has kicked in. This forces the master lessee to pay a minimum rent of 99.1 million Singapore dollars for the 2026 financial year. That guarantees a 24.3% jump in base cash flow from the previous year. It is an excellent, inflation-protected lease structure, but it is doing all the heavy lifting for the entire portfolio. And while Singapore carries the load, the situation overseas tells a different story. Here is the uncomfortable truth about the Japan segment. It is quietly eroding. Gross revenue declined by 2.1%. Net property income dropped 2.7% to 35.84 million Singapore dollars. Japan now contributes only 25% of gross revenue, compared to Singapore at 67.1%. This contraction is driven by structural Japanese yen depreciation and the liquidation of a key tenant. The raw organic rental revenue of the Japan portfolio is actively shrinking in Singapore dollar terms. We need to apply specific forensic attention to that tenant failure. The Miyako Group liquidation directly affects 5 nursing home properties in Osaka. Miyako Enterprise filed for corporate rehabilitation in December 2025, and Miyako Kenkukai followed with an outright bankruptcy filing in April 2026. Management took back these 5 properties early in the year. They state that the rental income represents about 1.6% of the portfolio gross revenue, and that security deposits of 4 to 8 months are largely sufficient to offset the outstanding obligations. Leasing discussions are ongoing, but those properties are sitting empty right now. So how is management covering this cash gap? Management explicitly states that the drop in Japan revenue will be compensated by foreign exchange gains from the settlement of forward contracts. They hold outstanding forward exchange contracts with aggregate notional amounts of approximately 103 million Singapore dollars, generating a fair value gain of 200,000 Singapore dollars in the first quarter. They are generating cash from financial derivatives to plug the hole, not from organic property rental growth. When we apply the 5-layer audit to this breach, the impact on your wallet becomes clear. The current dividend yield stands at 3.75%. Historically, this REIT has delivered a 3-year average yield of approximately 4.10%. Compare this against a direct SGX peer like First REIT, which sits on an optical yield of 8.40%. While First REIT is a definitive yield trap, failing multiple safety metrics, Parkway Life's yield represents the opposite extreme. If we stress test a further 10% depreciation in the Japanese yen over the next 12 months, the organic net property income from Japan will compress even more. Management will be forced to rely entirely on finite forward contracts, which are only hedged until the first quarter of 2029 to maintain this payout level. For a 55-year-old heartlander holding 50,000 Singapore dollars in this counter, this translates to roughly 1,875 Singapore dollars a year. That yield is functionally inadequate for the drawdown phase. This leads directly into my core read on the situation. Management spent considerable time highlighting the 15.1% distribution growth and their new environmental, social, and governance financing frameworks, including a 70 million Singapore dollar green bond at 2.103% and a 70.9 million Singapore dollar 10-year social loan. What they glossed over was the 2.1% contraction in gross revenue. Management said almost nothing about the Miyako Group liquidation, 5 Japanese nursing homes sitting empty, and they glossed right over it. They are plugging the cash gap with swap gains and pointing to the Singapore hospital rent step up to mask the organic decay in Japan. When a core geography stops producing real rental growth and relies on financial engineering to maintain distributions, the narrative is cracking. That is the reality. We must contrast this narrative with the cold mathematics of valuation. Parkway Life REIT is currently trading at a unit price of 4 Singapore dollars. The stated net asset value per unit is 2.53 Singapore dollars, which is actually down from the end of December. That decline is telling because the Japanese yen depreciation is already eroding the book value of the 650 million Singapore dollar Japan portfolio. This creates a massive forensic gap. The stock is trading at a 58.1% premium to its net asset value. Management points to an uninterrupted 18-year streak of distribution growth to justify this premium, meaning the market has effectively priced this asset for absolute perfection. Assuming the Singapore leases will perpetually insulate the portfolio, let us apply some plain logic to what this premium actually means. Imagine your favorite chicken rice stall. The actual ingredients, the plate, and the stall space have a tangible book value of 2.50 Singapore dollars. But because the uncle has never missed a day of work in 18 years, there is a massive queue, and people are willing to pay 4 Singapore dollars for that exact same plate. You are paying a heavy premium for reliability. But if the uncle's supplier suddenly raises chicken prices, or in this case, if the Japanese yen collapses and nursing home operators go bankrupt, that $4 price tag offers you absolutely zero margin of safety. Because you are paying that 58.1% premium to the underlying assets, the institutional money is already reacting. Your forward yield is completely crushed by the entry price. A fortress balance sheet is useless for retirement income if the price you pay mathematically destroys your ability to generate meaningful distributions. The unit price performance since March 2025 shows the REIT returning only 4.71%, against the broader market index at almost 25%. That stark underperformance against the benchmark signals that the market is already pricing in the Japan portfolio headwinds, even if management chose not to lead with them in their presentation. Let us look at exactly how this measures up on the forensic yield spread. For this audit, I apply a conservative floor of 3.2% because we audit for the storm, not just the sunny day. With the latest confirmed T-bill rate at 1.40%, our minimum yield hurdle sits at 4.7%. The current asset yield is 3.75%. While it mathematically clears the risk-free spread test against the sovereign curve, it completely fails our minimum yield hurdle. Furthermore, the CPF special account currently pays 4.0%, confirmed for the second quarter of 2026. This yield does not even clear the risk-free CPF rate. For a heartlander in the drawdown phase, this is the single most important metric to understand. Now let us review the income sustainability numbers in detail. Here is what the numbers are actually telling us. Gross revenue contracted to 38.15 million Singapore dollars, and net property income fell to 35.85 million Singapore dollars. Yet the quarterly distribution per unit spiked 15.1% to 4.42 cents. As we established, this is driven entirely by the Singapore lease mechanics and derivative settlements, not by an organic portfolio improvement. The forward yield sits securely in the fail column against both our minimum hurdle and the CPF special account rate. But we must also look at the foundation protecting that income stream. On the metric of balance sheet survivability, this REIT is the undisputed forensic winner. The debt health scorecard is exceptionally clean. The gearing ratio is a very safe 34.2%, staying well under our 35% ceiling. The interest coverage ratio is 8.4 times, crushing our minimum threshold. The all-in debt cost is a remarkably low 1.66%. The primary debt wall is not until 2027, and it sits within our concentration limits at 26%. Management has proactively addressed near-term maturities, extending the weighted average debt term to 3.8 years, which brings us to a critical distinction about risk. This balance sheet is a true fortress. The capital structure is solid, the interest rate is roughly 96% hedged, and the debt maturities are incredibly well managed. I want to be perfectly clear here. The problem with this asset is not the structure. The structure is practically bulletproof. The problem is exclusively the price you have to pay to sit inside it. If you want the full breakdown on counters like this before the free version drops, Iggy's elite investors get 0-day access. We track these yield spreads in real time, so you never overpay for a fortress balance sheet. The link is in the description. Let us look ahead to see if the future scenarios justify that current price. We must look ahead to see whether the current yield compensates for the future risks. In our bear case, a further 10% depreciation in the yen and additional operator contagion would compress the yield toward 3.5% as hedges expire, forcing capital drawdowns. In the base case, the yen stabilizes and Singapore covers the decay, keeping the yield near 3.75%. Your capital is safe, but it is mathematically inferior to the CPF special account. Even in the bull case, where the Miyako properties are released at higher rates and the France portfolio expands organically, the yield only edges toward 4%. It still does not clear our minimum hurdle. The timeline for resolving the vacant properties is the linchpin here. The Miyako resolution timeline is the key variable across all our projections. Management has 5 Osaka properties with 0 committed occupancy, dragging the Japan portfolio down to 93%. Given Japan's regulatory requirements for nursing home operators, securing replacement tenants typically takes 12 to 24 months. By contrast, the France portfolio shows 100% committed occupancy across all 11 properties, with 12-year leases and indexed rent escalations built in. France is structurally cleaner, but Japan is the immediate problem. This directly impacts how we score the management team today. We benchmark management's historical guidance against current reality. Their track record on the Singapore portfolio has been exemplary, with an unbroken 18-year growth streak. However, their previous communications implied the Japan portfolio's downside was fully mitigated by rent review provisions and security deposits. The outright bankruptcy of a major operator proves that these contractual protections merely limit the damage after it occurs. They do not prevent operator failure. They have lost forensic credibility on their downside assessment for Japan. Let me put this into a final forensic perspective. We evaluate management's credibility not by their tone but by the gap between previous guidance and current numbers. This team has earned top-tier credibility for their 18-year growth streak, and that is very real. But their prior guidance implied Japan was fully insulated. The numbers this quarter tell a totally different story. Organic revenue in Singapore dollar terms is falling. A major operator went bankrupt, and 5 properties sit vacant. They are delivering the distribution, but the foundation is shifting from property fundamentals to derivatives and lease step-ups from a single geography. The overall credibility remains intact, but the margin of safety in Japan is not. Before we reach the final verdict, there is one last thing to address. You are not here for the hype. You are here because you want the forensic truth before you commit a single dollar of your capital. And that tells me exactly what kind of investor you are. But the uncomfortable truth about independent publishing is that the algorithm only sees one signal, and that is whether you have hit the subscribe button. Every forensic investor who reads without subscribing is invisible to the machine. If this analysis has ever helped you identify a risk or calculate a margin of safety, subscribe for free right now and share this with one person who needs to hear it. Do it to tell the algorithm that data-driven market analysis deserves a seat at the table alongside the noise. Let us lay out the final forensic classification. Parkway Life REIT classifies as a defensive capital preserver with a fortress balance sheet. On suitability, it is a conditional pass for the accumulation and transition phases, but it is a hard fail for the drawdown phase. The single most important takeaway is that it offers institutional-grade safety, but you are paying a 58.1% premium for the comfort of those Singapore hospital master leases backed by IHH Healthcare. You are accepting a 3.75% yield that fundamentally fails to clear the CPF special account risk-free rate. Which brings us to the core issue with this asset today. This is not a broken asset. The balance sheet is a fortress. The Singapore lease structure is genuinely exceptional. And the European expansion adds credible diversification with index rent escalations. But none of that changes the raw arithmetic, because at 4 Singapore dollars, the entry price simply destroys the income case. Management explicitly states that the drop in Japan revenue will be compensated by foreign exchange gains from the settlement of forward contracts. They hold outstanding forward exchange contracts with aggregate notional amounts of approximately 103 million Singapore dollars, generating a fair value gain of 200,000 Singapore dollars in the first quarter. They are generating cash from financial derivatives to plug the hole, not from organic property rental growth. When we apply the 5-layer audit to this breach, the impact on your wallet becomes clear. The current dividend yield stands at 3.75%. Historically, this REIT has delivered a 3-year average yield of approximately 4.10%. Compare this against a direct SGX peer like First REIT, which sits on an optical yield of 8.40%. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.